This is David Ranson, and welcome to HCWE and our client webcast scheduled for November-December of this year. And the subject is unusual. It's the notion of a cycle in the economy that has not been noticed before. It's not a business, it's not the business cycle, but it is a business cycle. Let me start with some highlighted insights. Financial technology has made it possible to quantify market risk as never before. And we live in a very, very risky world today, quite out of the norm. Although the economy and capital markets have always been driven in part by fluctuating risk, in recent years, geopolitics has inserted greater and more variable risks as the Cold War has warmed up. It's now possible to recognize how the ebb and flow of geopolitical risk creates a cycle. It's a cycle in commodity prices, and it turns out it connects to inflation, capital markets, and Fed policy. I'd like to use this webcast to explain what I'm referring to. The first of my slides shows risk in the stock market, just as an illustration, although it's not the stock market that we're going to be concentrating on. If you draw this diagram, it's an unusual way to draw it, but you can see the green bars are inversely related to the blue bars. That's a way of saying that the index of risk in the stock market, the VIX, moves inversely to the performance of the stock market. The higher the risk, the lower stock prices get. The lower the risk, the stock prices start to rebound. I mention this because it also applies to other parts of the capital markets, and in particular the energy industry, most specifically the market for crude oil. Now, crude oil is an asset, but most economists don't analyze it as an asset. They analyze it as a consumer good, in effect, because, of course, it is from oil that we derive a large number of industrial commodities, starting with energy, but then the price system moves through the energy markets to the industrial markets and to the general market for business costs, and I'll be explaining how that affects the cycle later on. In the next slide, you'll see there's an inverse relationship here too. In this case, we're looking at the oil industry. Oil, seen as an asset, behaves like the stock market. When uncertainty and risk is elevated in the oil market, which we can measure now through a similar indicator to VIX, for the oil market it's called OVX, and that's shown as a red line in this graph going back to 2008 when this indicator was first launched. Notice that the oil price, which is the green line, is definitively related to the uncertainty and its inverse, just as the previous slide showed the stock market to be inverse to its risk. Most people, if you ask them, will imagine that an upsurge of risk is going to raise oil prices because they're looking at oil as the progenitor of consumer energy costs, and they're concerned with the supply and demand from a consumer's point of view. I'm suggesting quite a different analysis for oil, and the evidence seems to show that looking at oil as an asset rather than ultimately a source of consumer goods is very much supported by the evidence. Because oil prices are so closely tied to energy prices, then we will also see inverse relationships with OVX in the energy markets and beyond the energy markets, because the energy markets also influence other business costs and commodities generally. So I wanted to show that we can verify that with some data here in the form of a bar chart. Notice that we've got on the left, there are three groups of bars. On the left, you see there underneath the graph that these are the data where the OVX index increased the most. I'm using quartiles to measure that. So this is this looks at the history going back as far as we can with the OVX index, which is 2008. And on the left, then, those first three bars show what happens when the OVX increased the most. It shows metal prices now down, and it shows raw material prices down, just as it would have shown if we included the oil price. That would have been down as well. I realize how counterintuitive this is to so many people, but oil prices fall with uncertainty, and they drag metal prices down and raw materials prices down as well. If you go to the right-hand side of this graph, you get the opposite result. When we have a decline in OVX, a reduction in uncertainty, we get a large increase in the oil price, not shown here, but we also get a large increase in metal prices and in raw materials prices. So that sets off what I eventually want to demonstrate is a kind of cycle in the economy. Now, if business costs, starting with raw material costs in manufacturing, but the price system has the tendency to spread the price information, the inflation or disinflation information throughout the system. So as business costs, energy costs go down, so do business costs generally. And if business costs go down, then you have a bump up in profits. Not something people think about perhaps very much, but it's part of this cycle. And what I do in this graph, Exhibit 4, is to show there is a positive relationship between profits and OVX. So when you have more uncertainty, you have lower energy prices, lower costs, and higher profits. It's not a very tight relationship, but it is statistically significant. Moving along with the cycle, we have another change here, another graph here, to show that there's, of course, now we would expect an effect on stock price performance. With an increase in profits, stocks go up. Here I'm demonstrating that indeed does happen. When oil prices fall more than a certain amount, you get a rise in the stock market's performance. In this graph, that's the brown or the gold-colored bar. On the right, if the oil price increases substantially, then you get a small increase in the stock market. It would take a very, very large increase in the oil price by this, according to this graph, to bring the stock market down, but it does make a big difference to its performance. And as with all of these graphs, I'm including a couple of bars in the middle with extreme cases on the left and the right, and the kind of some average behavior in the middle, so that we can see that it is a consistent relationship. For example, if you go from the bottom of the green bar on the left to the middle green, which is barely visible, it's minus 0.6, and then you go up to 37.3 on the right, that is almost a straight line. And then reversely, if you look at the impact on the stock market, we have something in the 20s on the left, 13.7 in the middle, and 3.8 on the right. Another, roughly, it's a straight line. So we've now got a set of links from risk to oil prices to prices, costs, business costs, profits, and the stock market. And I want to start building a diagram in which we can see the chain of cause and effect. And this is the first element in that diagram in Exhibit 6. It shows an outbreak of geopolitical risk on the left, and then what you do to see the steps in the process, you have a red line leading to a depressed energy price situation, and then leading upward, then that's to the right, and then upward to a strengthening of profits and of stock prices. Just a way of summarizing the last few exhibits. Now, another thing to bear in mind is that oil prices aren't completely independent of everything else that's going on. That is to say, risk isn't the only thing that drives oil prices by any means. I'm emphasizing the role that risk plays in the oil market and all the other markets to which oil prices, the oil energy industry is related. But here is a graph going back a very long time frame, nearly a century, in which we can see that the oil price is very closely tethered, as I call it, to the gold price, which is a measure, of course, of the depreciation of the dollar. It's really an inflation indicator, and a very good one, as those of you familiar with our work on inflation would know. Look how parallel the oil price is to the red line in the gold price. So that is another element in the story that we have to keep in mind if we're going to forecast oil prices or explain them. And moving on now to Exhibit 8, I'm showing you a graph that some of you will have seen before, in which I show that a very simple formula, very simple indeed, involving the change in the oil price, but also the change in the gold price, that's enough to explain on an annual basis the change in consumer and producer goods prices. And this is just for the last 12 years or so, but this graph could be plotted for the last 75 years. It's enough to look at the last 12, but I assure you that the fit is as good going all the way back, that the formula that I'm using is estimated by least squares from the entire 75-year history. And it is actually quite remarkable to find that the last 12 years in this history fit the formula so well. We have ups and downs, quite a lot of ups and downs recently in the inflation rate, and you see that this little formula doesn't contain anything except changes in these two commodities, oil and gold, and it's enough to explain a very large part of the behavior of inflation. To rub that in, I have in Exhibit 9 plotted the same basic test for the consumer price index. And you see the story is pretty much the same. The difference between the previous graph and this one is really in timing. You can't see it in the graph, but if you reading the labels, you can, let's see, I don't think it's visible in the graph, and I don't think I've got labels to show it. So let me explain that the consumer price index moves later than the producer price index, and therefore this primitive formula involving the commodity prices, oil and gold, anticipates consumer price inflation much more, far more than it anticipates producer price inflation. It's a time sequence in which oil prices, in the sequence, gold prices move first, oil prices move second, producer prices move very soon, almost immediately after oil prices move, and consumer prices move last, about a year later on the average. Moving on to Exhibit 10, I'm showing here the link one step further from inflation. When inflation occurs, especially if it's a major change in inflation, the Fed responds. And what I'm plotting, so there's a link that goes all the way to the beginning of the chain, OVX, risk in the energy markets or the oil industry, and the Fed's interest rate policy. And obviously there are many links in this chain, but this is just comparing in this graph the beginning of the chain with the end of the chain, and we do see an inverse relationship. Of course, there's slippage at every step in the chain. I'm simplifying at every step, but this is a pretty good inverse relationship in spite of all the slippages that can occur because of the relevance of other factors that I'm not paying attention to. In Exhibit 11, I can now put this into a flow diagram of cause and effect. We see the outbreak of geopolitical risk, and we move along the red line as before. We have a depressed price situation in energy markets, but this time we show the effect on inflation. Energy markets affect business costs, manufacturing costs, as I mentioned, and business costs are correlated with inflation, as we also is very plainly shown in the last two slides. And so depressed energy prices means decelerating inflation, and decelerating inflation means Fed rate cuts. So that's another aspect of the cycle. That's one way to show it in the flow diagram. Now, we've only got halfway, because one of the things that happens when you have an outbreak of risk over a period of time, and the period of time may vary from situation to situation, can be a long period of time, several years, or it could be almost immediate. But you see here an example where things happened immediately. After there's an outbreak in OVX, look how quickly the OVX drops back down to where it came from. And something of that sort happens with the stock market too. I've included the VIX index as well to show how VIX reaches a peak and then falls back. So and the nature of risk is that it doesn't stay forever. It may stay a long time depending upon the situation, and it is staying with us at the moment rather a long time, but on many occasions in the past it has reversed itself very quickly. That is to say that people who feel the risk, the uncertainty, and make decisions based on it, psychologically speaking, they don't continue to feel it. As time passes, their feelings relax. I call it the relaxation of risk. And you see it very clearly in the case of the VIX index and the OVX index in this chart. So now I can draw another flow chart diagram. It's actually very similar to the previous one they were looking at. Now I'm using a blue line to indicate it's the other side of the cycle. We started in the previous flowchart with an outbreak of geopolitical risk. In this case, the outbreak is followed by a relaxation of geopolitical risk, and that sets off a new sequence of events, and they're marked by the blue arrows here. So the relaxation of risk allows oil prices to rise. They were distorted downward by risk, and now they're moving back towards normal in the flow. And if you follow the blue line upwards, that's going to increase energy costs, business costs, manufacturing costs, and it's going to lower profits, and it's going to hurt the stock market. Just the opposite of everything in the previous chain of events. We can also follow the blue line to the right, where we get increased inflation, accelerating inflation, and the final link in the chain is the Fed hiking rates, which it will eventually. So that's my story. That sets up a cycle. The the outbreak of risk leads to a deceleration or relaxation of risk. So you have a whole chain of events affecting capital markets and inflation in one direction, followed by the same chain of events affecting all of the same links in the chain in the opposite direction. And I've put all of that into one page now, a complicated flow diagram, which it would be difficult to interpret if we hadn't shown the pieces of it one by one already. I'd like now to introduce my friend and colleague Frank Kane, who has designed some questions that I'll address. And here's Frank.
David, some years ago, so-called modern monetary theorists argued that basically deficits don't matter. Taken to its logical extreme, that would suggest that maybe income taxes don't matter either. But coming back to earth, what's your point of view on the apparent disinterest Congress, Treasury, and the bond market seem to have about our ever-increasing federal budget deficits?
Like many institutions, the federal government is always in the business of enlarging itself, especially through increased spending, and the deficit is an undesired constraint. Another reason the Treasury and Congress may appear disinterested is that most of the time they have pressing economic and political concerns closer to home. There's also a complacency that results from the wonderful resilience and continuing growth of the economy up to now. At some point, obviously, the ever-increasing federal debt will reach a point at which the economy can no longer grow fast enough to service it. It would take quite a crisis to make Washington prioritize the deficit, and even then the reaction of many politicians would be to pursue an income tax increase. I believe that response would worsen the deficit threat by further slowing the economy. The bond market is different. From the system's point of view, its chief function is to put a price on the financial condition of the US government. It was doing that recently when long-term interest rates rose in the face of Fed cuts in short-term rates.
I'm also curious about what happens when we add to or draw from the Strategic Petroleum Reserve. Presumably the petroleum reserve is a national asset, and drawing from it is equivalent to a sale of crude oil by the federal government. And if that sale results in income to the Treasury, presumably that's like tax revenue and reduces the budget deficit for the year in which the drawdown occurs. Presumably the opposite would be true as well. Maybe the numbers are too small to worry about, but do we know how this works?
Yes, a sale of assets results in income for the Treasury and reduces the budget deficit. But the numbers are indeed pretty small relative to the multi-trillion-dollar federal debt. What is large enough to make a difference is the highly unlikely possibility of selling off federal land, the value of which is astronomical.
Last question. One of the hot topics these days is tariffs and the possibility that the tariff wars are likely to escalate before they subside. Looking back over the last 5 to 10 years, what do the data tell us about the impact of U.S. trade or tariff policies on inflation in the U.S.?
For a long time, tariffs have added up to a very small and stable percentage of the value of trade. There hasn't been enough variation in the last 5 to 10 years to assess empirically what impact they have on the volume of trade, GDP, or inflation. There is, of course, a fear that large US tariff increases would invite retaliation and cause a global recession. That's what happened after the famous Smoot-Hawley tariff of 1930. The Great Depression followed, although cause and effect has never been established.
In any case, the US economy is much more sophisticated and efficient today than in 1930 and offers far more opportunities for substituting one source of supply for another or switching from one target market to another. As far as inflation is concerned, there is economic logic to imply that in what is called general equilibrium, tariffs change the relative prices of domestic and foreign goods and services, but not inflation as a whole. Thank you. That's the end of our Q&A session, and I'm grateful to Frank for providing the questions, and that completes our webcast for this month. I look forward to doing another webcast in March in the coming year, and until then, thank you.